Hello everyone, this is Brian Rezny, President of Rezny Wealth Management and host of the Rezny Wealth Report. We're here live every Wednesday evening at 6 p.m. and of course our program is replayed on Sundays at 7:30. Make sure you visit our website, reznywealth.com. Fee-only money management without the conflicts of Wall Street. If you're interested in active money management, which includes risk management, call my firm for a consultation. There is a difference. We invite you to experience it. You know, I want to talk a lot today about what's going on in the economy. You're seeing the stock market in the last week or so has had a pretty sizable sell-off. We continue to see gold hit multi-month lows, and investors are getting nervous. Investors are wondering, is the economy slowing down? Should I be bailing out of the stock market? One of the problems that most investors face is this. You don't have an investment strategy, which includes risk management. I know what you're saying, but Brian, I've got an advisor. You don't. Most investors, in fact, about 90% of investors don't have an actual investment management firm. You're working with a Wall Street firm or an insurance salesperson or a broker who uses a fancy title, but they actually don't manage your wealth, meaning you don't have an investment strategy and you don't have a way to mitigate risk in severe prolonged down markets. Now, we've seen some gyrations in the market this week. In fact, of course, on Monday, the market sold off. We had some recoup yesterday, and then today, another big sell-off. What this is telling me is this. There's getting to be a little bit of antsiness in the market. This is natural after a fairly decent run-up over the last couple months. But we look at our market trend indicator, which are various moving averages, and we look at our relative strength indicators over many different investment sectors. We don't just look at stocks and we don't just look at bonds, but we want to look at all broad-based sectors, including cash as a safe haven. Too many investors, unfortunately, get lulled into buy and hold investing or set it and forget it, passive asset allocation, which is a failed investment approach. Ask yourself a simple question. How did your portfolio do in 2000? Did it go down 30 or 50% when you asset allocated your money or you set it and forget it? What about 2008? Did you have the same repeat? Unfortunately, we will have other recessions in the future. The problem is, unless you have a decisive way, not emotional buying and selling, but a decisive risk management strategy built into your investment portfolio, you're going to ride the roller coaster of all investment markets, not only the stock market up and down, but eventually the bond market's going to collapse also. You're going to see mediocre returns in your portfolio because you tend to hold on and you wait for things to come back. Bottom line is this. There's times you want to own various investment sectors, which may include the stock market or might go to cash. And there's times you want to sell these same assets when things start to get relatively weak in a prolonged downtrend. I want to bring up a quick chart of the S&P 500. And basically, we look at three mechanical averages. We look at the 35, the 100, and the 200-day moving average. Clearly, our first indicator is the 35-day moving average. This is basically a short-term moving average that tells us the direction of any investment sector. Now, I'm talking about the stock market right now, the S&P 500, because most people have heard of the S&P 500. Generally speaking, the S&P 500 is still in a positive uptrend, even though we've had a few days of gyration. It's right around that 35-day moving average, and it's just broken beneath it. What that tells me is it's an early warning sign. It's just a yellow flag that comes out and it tells me watch things a little more closely. If things did start to deteriorate, what ultimately happens with the way we manage money at Rezny Wealth, if the stock market and the S&P is just one facet of it, starts to get relatively weak against cash or safe assets, we start to migrate our client portfolios into safe assets. We do not want to ride things down 40 or 50%. If another recession is around the corner. I'm not saying it is right now, but we will make adjustments accordingly. Risk management is one of the things too many investors lack in their portfolio because, again, the person you think is managing your money is really no more than a salesman of investment products their firms represent. So ask yourself a question. What's your investment strategy and how do you mitigate risk? Ask your advisor, when do you sell? How do you mitigate risk? What's your risk management strategy? You're probably going to find out Brian Rezny was right. We're dealing with a sales firm or a Wall Street company, and there's no way that they're going to actually mitigate risk in our portfolio, so we're pretty much set it and forget it on cruise control. And again, it didn't work the last two times in the last two recessions in 2000 and 2008. And I firmly believe investors that take a lackadaisical approach to buy and hold are going to suffer again eventually when we have a recession. Now, generally speaking, a lot of the signs we're seeing in the economy are actually not that bad. What I will tell you is relatively weak. I always talk about relative strength in an uptrend, relative strength, weakness on a downtrend. Emerging market large cap primarily is really, really weak this year. In fact, most emerging market large cap economy stock markets are actually down 5, 10, even 15%. So what I want to tell you is this. Relatively strong so far has been the U.S. marketplace, but it's starting to show a couple signs or cracks. Again, a little yellow warning sign. We're not emotional. We're going to follow a strict strategy that's helped guide us in the past. We firmly feel it will guide our clients in the future. What I'm going to tell you is this. You avoid relatively weak investment sectors going down, and you want to look at investment sectors that are trending up or being positive. Sometimes that means being conservative and going to cash. I want to talk about the number one question I keep getting. Unfortunately, too many of you listeners did not heed my warning about relative weakness in the gold market. And guess what, folks? Gold hit another 52-week low again today. In fact, gold has lost about 15% of its value in just the last 3 or 4 days. This is a chart of gold. It doesn't look real pretty, does it? You can clearly see from the right side, it's under its 35-day moving average, meaning that yellow flag that I talked about was broken after across the intermediate 100 and the 200-day moving average. The worst part is this. The 35, the short-term average crossed below the 200. That has typically been a great time to bail out of an asset category under many circumstances. It's not a perfect indicator, but it works pretty darn well. Well, guess what, folks? The 35-day crossed below that 200, and it crossed below a long time ago. You're seeing gold get weak. The small investor, unfortunately, jumped onto the gold bandwagon because all these hysterical commercials on TV. You bought gold, and now you're going to ride it all the way down. Let me tell you what happens to the small investor. They come late to the party, they buy what's fashionable now, and they don't know when to sell. Unfortunately, gold, in my opinion, will probably go a lot lower than it is. It's relatively weak. In fact, gold's off close to 20% year to date. What also is interesting is the gold miners are off 35 to 40% year to date. Those have been two of the most weakest sectors of investing, relative weakness going down. These are areas that should have been avoided. In fact, I put out a warning back in December of 2012, and I told investors gold fell out of our top ranking based upon our proprietary strategy. We sold gold in our client portfolios at the end of December 2012. That was public. I talked about it on my TV and radio show. I hope you listened to me then, and I hope you're going to listen to me now. The bottom line is this, folks. Relative weak assets or sectors often underperform and often gain momentum on the way down and have bigger losses. I hope you don't own gold, and if you do, you figure out a way to mitigate risk and when you should sell. I have to take a short break. I'm going to come back with your calls and your questions after the short break. Please visit our website, ReznyWealth.com. Better yet, call my firm for a consultation. If you're tired of passive investing, if you're tired of being told, hold on, things will come back, if you're finally realizing, Brian, the light bulb went on and I realized I need a way to mitigate major catastrophic loss, and you don't want to suffer in the next recession, call my firm for a consultation. Active money management without the conflicts of Wall Street. I'll be right back with your calls and questions after this. Hi, I'm Brian Rezny. If you're like many investors, you've lost a lot of your retirement assets due to poor investment management or being sold investments that are often better for that so-called advisor than you. Most so-called advisors are just salespeople or brokers for investments their firms represent. No real advice at all. If you're tired of bad investment advice and are ready for positive change for your retirement, call my firm for a consultation. Don't settle for bad investment advice. There is a difference. Call us today. Hello everyone, this is Brian Rezny. Of course, we're coming off break and we're talking about your portfolio. We're talking about relatively weak sectors. Gold is one. By the way, Apple got killed again today. Apple's hitting, again, another 52-week low. It's relatively weak against the two main investment sectors that it belongs in, which is the NASDAQ 100 and the S&P 500. Bottom line, relative weakness often brings more relative weakness. I hope you also listened when I told you to sell Apple, and we sold it last year. Bottom line is this, folks. Relative weakness and a way to mitigate risk in your portfolio is going to be more important than ever. Passive investing failed not once but twice in 12 years. If you let it happen to yourself a third time, you're making a big mistake. I'm taking your calls right now, so if you have a question about a stock, a bond, a mutual fund, maybe some insurance salesman sold you 5 annuities and you're realizing that was a bad mistake, or you attended some free lunch seminar and you were pitched some sales about equity index annuity or some other kind of hideous product that's bad for your portfolio, call me in the studio. I'll answer your question. I'll set you straight. I'll tell you exactly what you should be doing with your money. Robert in Marco Island, do you think we're headed for a correction? Robert, this is what I would tell you. We may be headed for a correction, but I never talk about my opinions generally speaking. I talk about fact. Right now, we've had just a little bump in the road. We're watching our market trend indicators, our MTIs we call it, our in-house system. These are our short-term, intermediate, and long-term trend indicators of all investment sectors. Right now, generally speaking, the U.S. marketplace, small, mid-cap, and large, are still in a positive uptrend. Large-cap emerging market are definitely in the doldrums, and we don't own large-cap emerging market. I'm going to tell you that right now. Our positions can change at any time. We're looking at the relative strength of these different sectors, and the end of the month is coming soon. We may be making a change up in our portfolio, and we may start raising cash. What I'm going to tell you is this. We don't run an emotional portfolio. We run a strict strategy, which helps guide our portfolio and our clients into what needs to be done. So what I'm going to tell you is this. We may be headed for a correction, or we may not be. If things get a little bit worse and our market trend indicators trigger and our relative strength, meaning sectors that are more safe and conservative like cash or treasuries, filter back in our top rankings, we may start selling equity-based investments or assets on their way down that are getting weak. Bottom line, you need a decisive way to figure out if you're in a correction instead of, are we in a correction? Again, that's usually opinion. You want to look at fact, you want to use moving averages, and you want to use relative strength. Robert, I hope that answers your question. If you want to know more about my firm, go to my website, ReznyWealth.com. Better yet, schedule a consultation at our Naples or Fort Myers office. Rob in Naples, the firm I use is more buy and hold asset allocation. What do you think of asset allocation? Rob, asset allocation is outdated, ineffective, and it's a flawed approach. Wall Street dreamed up asset allocation. It's basically this magic pie chart they show you, and they tell you invest in 8 or 10 or 15 different investments. The problem with asset allocation and the whole premise around it is these firms don't know what's going to happen. Okay, because they want to spread the money everywhere. You're going to own the good and the bad with asset allocation. What I would tell you is more effective. It's called relative strength investing. What you do is you look at all these categories that are in that, let's say, 64 box of crayons. So you've got all the colors that you're looking at. You only pull out the crayon colors that are appropriate for the picture you're going to color today. Asset allocation's premise is you always own all 64 crayons or always use them to color a picture. That's a flawed approach because if half of those crayons are not appropriate for the next month, 6 months, or 6 years, why would you own investment assets that are not appropriate? That is really a bad strategy because, again, the bad investment sectors that are going down drag down the return of the good sectors going up, and you basically don't necessarily take a lot more risk, but your returns often become mediocre at best. Asset allocation is ineffective, and firms that do over asset allocation or diversification basically tell you they don't know what they're probably doing, so they're going to spread the money everywhere, and hopefully something works and something helps protect, but a lot of stuff goes down. Don't own relatively weak assets in a downtrend. Asset allocation tells you to own those things all the way to the bottom. Asset allocation didn't work in 2000. It didn't work in 2008, and I firmly believe it's not going to work again in the next market correction. If you're like Rob and you have a question about your portfolio, in the studio, 239-417-4711. If you have a question about any investment, please call us in the studio right now. We want to help answer your question and get you on the right track. Sue in Fort Myers. I own GLD and GDX. What are your thoughts about each? Oh, Sue, I hope you've been listening to my show. GLD is basically an ETF that basically buys and owns physical gold, for those viewers who don't know what that is. GDX actually owns the gold miners. Sue, I don't know what percentage of gold or the gold miners you own in either one of those ETFs, but I'm going to tell you this. Our strategy, our relative strength strategy, told us in our portfolio and our strategy to sell gold back last December. We don't own gold, and it continues to get weak. I would not own gold now because our indicators are telling us gold is in a sell and in a downtrend. The gold miners, GDX, is down almost twice what gold is down year to date. These are even weaker. So again, more weakness typically brings more weakness. Sue, I think you're making a big mistake by buying gold and gold miners or holding those. I don't know what your strategy is, and I'm guessing you bought gold and gold miners because you thought they magically go up if the stock market goes down, or because of inflation, or because of money printing. I can tell you both of those sectors are weak, and if you continue to own weak sectors, it can pretty much rest assured you're going to continue to lose a lot more money in the future. I would be a net seller. I'd wait for it to bottom and start to gain relative strength again. And if it filters in the top of a ranking system, they may be another potential buy down the road. We have gold in our crayon box, as I call it, or the stable. We don't own it. We're watching it. And until gold starts to get relatively strong again, we're not going to touch it. If you're like Sue and you have a question about your portfolio, please call me in the studio, 239-417-4711. Steve in Naples, I own mostly large cap stocks in my $900,000 portfolio. I lost big in 2000 and again in 2008. Would you be selling now? What I want to tell you is this. I wouldn't just randomly just start selling something, Steve. Investors, just because we get a little turmoil in the market doesn't mean you just go and just wholesale your whole portfolio. What I'm going to tell you is this, though. Why do you just own large cap stocks? That is one dimension, one-sided, and that's ineffective. What about small cap or mid cap? What about emerging markets? What about oil, currencies, gold? What about bonds or treasuries or emerging? All of these different asset categories, as I talked earlier, should be part of your stable or your box of crayons. You want unlimited asset categories that you can look at, but own the stronger categories. The problem, Steve, you're going to have is by just owning large cap. If large cap isn't doing that great, you only own large cap for the next 5 or 10 years. If the stock market goes down, a rising tide lifts all boats and also sinks it. Your large cap stocks are all going to go down in the next market correction or the next recession. Statistically, we have a correction and or a recession of 30 to 50% magnitude about every 6 to 7 years. We may have a recession next year, we may have one this year or 5 years from now. The bottom line is this. Why would you just own large cap stocks? I think you're missing out on so many other great opportunities and sectors and subsectors, and I think you're going to miss return, and you're actually increasing the risk of your portfolio because ultimately you're going to own large cap all the way down in the next recession, and you're going to get hit again. I would suggest you call a firm like mine. Let us manage your portfolio. We have a much more defined investment strategy that's objective, and more importantly, it's adaptive to changing conditions in the economy and the investment markets. I have to take a short break. I've got time for 4 or 5 more calls. Go to my website, ReznyWealth.com. By the way, we're going to have some upcoming Adapt or Fail workshops in Fort Myers in the next few weeks. Go there, check them out, and sign up. You'll be glad you did. I'll be right back with your calls after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Do you know the biggest risk to your retirement and investments? One is entrusting your hard-earned money to someone who doesn't work in your best interest. The other is a lack of a detailed investment strategy to meet your goals. Both risks can be devastating, but both can be corrected. Rezny Wealth Management, fee-only money management. Don't settle for questionable investment advice. Call my firm for a consultation. There is a difference. Hello everyone, this is Brian Rezny. We're talking a lot about what's going on in the last couple days in the market. Of course, we had a potential terrorist attack in Boston, and of course, our heart falls for these people. You never want to see things like this happen, but you can see when a little event like this happens, what happens to the investment markets. You saw what happened to gold, you're seeing what's happened to the stock market. Unfortunately, these kind of events are going to be commonplace in the future. We've seen this stuff happen before. It's not pretty, but at the end of the day, events like this around the world are going to continue to occur. You have to realize that these often are short-term events, and don't make decisions based upon the news or the noise that you're seeing from a knee-jerk reaction from something like this. It's a terrible event, and again, we feel sorry for all the people that were injured or lost their lives, but at the end of the day, don't make emotional decisions off something like that. It's going to hurt your portfolio. A detailed investment strategy, which includes risk management, is going to be more important than ever, and I can't stress enough for you investors. Set it and forget it. Passive investing is a failed investment approach. Sometimes you need to sell and you need to raise cash. That's an important part of money management. I'm taking your calls or questions at 239-417-4711. Please go to my website, ReznyWealth.com. You can sign up for our weekly newsletter. It comes out. It's free. You can also sign up for our Adapt or Fail workshop. It's perfect for you retirees who have lost money in the past and realize you need a more effective way to manage risk in your portfolio instead of being told, hold on, things will come back. Ed in Naples, I'm hearing a lot about ETFs. My advisor doesn't recommend them. Why? Ed, ETF stands for Exchange Traded Fund. Okay, so that's ETF for short. ETFs, there's over 1,000 ETFs today, and basically an ETF is a low-cost structure investment that's very transparent, that owns whatever investment category you want to. As an example, if you think you want to invest in the S&P 500, there's a number of ETFs that actually own the 500 stocks of the S&P 500. Or if you did want to own gold, or you wanted to own publicly traded REITs, or you wanted to have currencies, or you wanted to have an inverse ETF, there's over 1,000 ETFs. What I like about ETFs is they're transparent and they're low cost. Your advisor doesn't like them because your advisor is really a broker or a wolf in sheep's clothing. Most of these so-called advisors and brokers don't like ETFs because they don't make any money when they sell them. ETFs are far superior to mutual funds, but mutual funds line your advisor's pocket the most and their firm because of revenue sharing agreements and the commissions and the internal cost structure. Most mutual funds fail to beat their base index. So if they can't beat the base index and they have high expenses and mediocre returns, why do you want to own most mutual funds? You don't. Your advisor, which is really a broker, I'm guessing, wants you to own them because he makes a bigger commission and a trail, and it's a set it and forget it asset allocation. His brokerage firm likes you to buy them because they also get ongoing revenue sharing, more money they allocate to one fund family over another. Mutual funds are, in my personal opinion, are not near the quality of an ETF that's a low-cost structure, transparent, and owns that base index. And what's nice is you could look at any asset category almost today and find an ETF that's more effective. When you work with a fee-only firm like Rezny Wealth Management, we primarily use ETFs because we know the cost benefit and the actual performance benefit we feel our clients can gain from the transparency and the cost effectiveness of using an ETF. What I would tell you to do is get a second opinion. Call my firm for a consultation. We'll talk more in detail why ETFs are far superior, but more important, we'll talk investment strategy, which includes risk management, which I guarantee you your so-called advisor doesn't have. Rob in Fort Myers, do you like emerging markets as a sector? Any recommendations? Rob, the emerging markets are in our stable of what we call investment sectors that we track. We currently only own small cap emerging markets because most of the large cap emerging markets are actually relatively weak and they're in a downtrend. So what I would tell you is this. It's not that I like one sector over another. We own what's relatively strong and what's working. So if a sector is relatively strong and it's ranking high, we own a diversified portfolio of those top sectors. Large cap emerging market primarily is in a downtrend and relatively weak against many other sectors. We do not want to own what's not working or what's getting relatively weak. So what I would tell you is this. There's many ETFs in the emerging markets you can research yourself, but right now is not necessarily the time to own large cap emerging market because there's other sectors that are greatly relatively stronger and outperforming emerging markets. Sam in Fort Myers, my advisor is really pushing hard on a variable annuity. You stress stay away from annuities. Why is he so adamant? Sam, simple. Your advisor is a salesperson of annuities. He's probably got an insurance license only, or he's got a Series 6 license. And brokers and so-called advisors love to sell annuities because they pay amongst the highest commission of almost all products. Annuities are dangerous to your portfolio and your wealth. They come with higher taxes when you take the money out. If you did make money, they have extraordinarily high expense ratio internally. They have limited and often mediocre investment options. So you combine all of that mediocre and expense, that's an annuity, and it doesn't belong in your portfolio. Your advisor probably has a car payment or a house payment to make, so he wants to sell a big expensive annuity to you and your family, which in my personal opinion, again, is probably one of the worst investments ever invented. High expenses, mediocre investments is going to take away from your real return. Those guarantees they talk about often don't live up to what you think they are. So at the end of the day, before you buy one of these products, make sure you understand the expenses, the cost structure, how the taxes are going to be paid when you take the money out. Unlike a dividend account or capital gain account, money that comes out of annuities that was actually earned money is taxed at ordinary income rates, often double what capital gain and dividend rates are, double. And the worst part is, if you did make money and eventually one day when we all pass away, your heirs do not get a stepped up basis either. They got to pay tax at ordinary income, unlike stock, mutual funds, or ETFs that would have a stepped up basis. There's not many good things I can say about any annuity, and I would tell you avoid them because they're highly complex, they're expensive, and they don't belong in your portfolio. Folks, I am just about out of time. I've got just about a minute left. I thank you for all your questions. Visit my website, ReznyWealth.com. I always tell all of our TV and radio listeners, you would benefit from a consultation with my firm if you're realizing buy and hold, set it and forget it, passive allocation is a failed approach. You want a better way to control risk in the next down market. You want a better way to grow and protect your money. And you want a firm that works in your best interest. Call my firm for a consultation. The number's at the bottom of the screen. I'll be back next week.